Welcome to the GSX Podcast, where we explore the evolving landscape of commodities, trading, and alternative capital. Hosted by me, Henry Walsh, and the team at Great Southern Cross Commodities, the podcast brings together market participants, managers, and investors to discuss how capital, policy, and innovation are reshaping the global commodity markets. From carbon to coffee, energy to macro, we cover the full commodity investment universe, unpacking the trends, risks, and opportunities that matter. In this episode of the GSX Podcast, I sit down with Kim Morison, founder of Argyle, to explore one of the most overlooked investment assets, water. Drawing on a career that spans commodity trading, agriculture, and funds management, Kim explains how Australian water entitlements work, why they can offer both income and capital growth, and how they fit into the broader evolution of irrigated agriculture. We also discuss the rise of high-value crops, the complexity of regional water markets, and the lessons learned from building a pioneering business through both growth and adversity. Please enjoy my conversation with Kim Morison. Please note, the views and opinions expressed on the GSX podcast are those of the host and guest and do not necessarily reflect the views of Great Southern Cross Commodities or its affiliates. This podcast is for informational purposes only and should not be considered as financial, investment, or trading advice. Listeners should conduct their own research or consult a professional advisor before making any financial decisions. Welcome to the GSX podcast. Today, we're talking about an asset most people don't think of as investable, water. Kim Morison leads Argyle, which invests in Australian water entitlements, perpetual rights that generate an annual allocation of water that can be sold or leased. The thesis is water as a scarce real asset with an income component, potential capital growth, and diversification away from traditional markets. I've been fortunate enough to know Kim for several decades now and was my boss for a while at Collie Cotton and Macquarie. And he has had a very interesting career and is also from the wonderful state of Western Australia originally. So welcome, Kim.
Thanks very much, Henry. Great to talk with you.
I thought we'd just kick things off with a bit of history about yourself and background and how you ended up doing what you're doing at Argyle, because it's been an interesting journey. And I think a lot of people would find the journey different to a lot of other people. So why don't we start there?
I guess fundamentally, I grew up on a farm in Western Australia and agriculture has always been of great interest to me. Progressed towards in a career in commodity trading and then in investment management and agriculture was really around the fact that, Australia does two things really, really well. We've got great mining industry and we're very competitive agriculturally. That sector of the economy is very much privately owned, family businesses. They're often starved of capital. They are structured in a way which is difficult for them to raise capital. And I guess my involvement in exporting commodities, principally cotton, then later sugar, to export markets across Asia gave me some realisation that there were opportunities for us to do more than just service these bulk exportable commodity markets of the past, and that we had opportunities to try and provide higher value horticultural fresh produce to those export markets, particularly having written a lot of free trade agreements through the early 2000s. And the rise of per capita wealth amongst our near neighbouring countries. But what we needed back on the farm was how to invest capital to transition away from the sort of bulk undifferentiated commodity production of the past. And so that became the mission. How do we raise capital to invest and supply that capital to private family businesses? And the way that we have structured that has been, irrigated agriculture is something which in the Australian context probably has more reliability of earnings, because if you have water, you can make things happen. If you're just relying on rainfall, you're going to have a lot more variability in how production evolves, and that's a greater degree of risk then. But if we could invest in the water rights, which are all privately held by farming businesses, big component of their balance sheet, that we could then invest to buy those water rights, lease them back to those farmers, allow them to still keep using the water as their key input, but liberate a block of their own equity capital that they could then reinvest in the transition of their own farming businesses. And so that's really fundamentally where we came to be, and we've been executing on that for the last 15 years or so.
Yeah, interesting story. I just want to pick apart a little bit, like the transition from, as you say, commodity trading businesses, Coley, Macquarie Cotton, and CSR, and then when you started the water business. And I remember having a coffee with you, you're probably a year or two into it. And I know it wasn't easy getting the business off the ground. It's not like you're, selling an equity fund or even at the time, regular commodity funds are more exciting. Tell us a little bit about that journey. There's probably a 2 or 3 year window where it was pretty challenging getting capital raised and deployed and executing the strategy. And obviously once you got going, it grew very quickly, but that transition must have been a challenge.
Yeah, it certainly was. And, first of all, we were investing in assets that really no one had any understanding about. The Australian water regulatory framework is rather unique. So in Australia, water is scarce for a start, and over many decades, really, we evolved to having this regulatory framework, which is a cap and trade system where we've said, look, we need to preserve enough water to make sure the environmental assets are not degraded. So there's enough water that's still flowing through the river systems and maintained in aquifers, so we can maintain healthy environments, the fish, the frogs, the birds, the trees, but then cap the amount of water that we're extracting for irrigated agricultural mining and regulate that in a way that it is all accounted, it's all policed, no one's able to use more water than they're entitled to, and essentially then put in place a mechanism that water should be able to be utilised by those enterprises which are deriving the highest value. So the principles of the whole thing being we've capped the extraction, regulated how much can be used, but let's have a market mechanism to actually allow that to transact and then find its way to those who derive the highest value. Explaining all of that to investors is really challenging, because it's not something anyone understood and it required a whole lot of education. Most people have a pretty good understanding of alternative investments like private equity, private debt, infrastructure, agriculture even. But when it comes to water rights, it's like, I don't understand that. And so most of our time was taken up going back and explaining all these principles, how it came to be, how it operates, how the returns would be generated. And to be honest, much of the audiences that we come across are fascinated by it, really are interested. And then it's sort of, the feedback we get is like, oh, these people are really engaged on what we're talking about. But, reality was that we were very pioneering in what we were doing. No one had done it before. There wasn't a track record established. There wasn't really a lot of observable results of others have done it in the past. And so that took a lot of time to get the first people to invest and then create that track record and create the confidence in what we were doing and demonstrate it. And so, it was a really slow start and a long journey, and certainly rewarding to look back on now. And we've delivered, above the target that we initially expected to investors. But at the same time, it is an investment which is not correlated to anything else and is something which is reflecting the variability of Australia's climate. From year to year, we have a lot of variation in rainfall in the regions that we're invested in. And some years we have an abundance of rainfall, and some years we have droughts. And the whole rationale for having an irrigated agricultural sector is that we capture that water when it's abundant to then make it available in later years when it's not so abundant. And so to invest in this, you really need to have the patience to be invested through the cycle, because there are going to be times where the water rights that we've invested in, there's lots of water available, and our ability to generate income in those years is much more difficult because there's a surplus of water available. And then in other years, there's a scarcity, and that's when we can generate some sort of outsized income returns.
How do you balance that? Because as you say, like the returns are sort of generated from 3 different ways, right? There's some capital appreciation, there's the trading of water, and then there's the leases. Do you try and balance the portfolio between those 3? Capital appreciation is ideally persistent, but in terms of how you position that, so in the last 6 or 7 years, right, it's been a really big cycle from extreme drought to a lot of rain. Walk us through how the portfolio changed its revenue generation or income generation over that period. I think that'd be a good sort of case study for everyone to sort of understand a little bit.
Yeah, I guess the first thing that we look at is, we're not constrained to where we invest in Australia geographically. So we look at the whole Australian water markets as basically there's about $50 billion worth of water rights on issue across different geographies. Each of those is its own market. It's kind of like a stock market with 300 different stocks, if you like, 300 different types of water entitlements, different rivers and aquifers and so forth. And we have a process to identify which of those that we think are going to produce the greatest reliability of yield, that we can sell water and we can generate good return for the capital that we've invested. And where is it that we're going to see a tendency for those assets to appreciate? Because each of those regions, the water rights on issue is capped and finite. There's no more going to be issued. It's really constrained. But it's a matter of how the farmer's ability to pay for water can transition over time, and where is it that is happening the fastest. So in the first instance, we're looking at, which of those regions that we can see there's a change going on. And in particular, that's been around a shift in water use over time from those bulk undifferentiated commodity crops to something more specialised that's higher value. So where we're seeing a shift from rice to cotton, and then cotton to citrus or table grapes or almonds that have a far greater gross margin per unit of water that's being derived. Then it's a matter of, once we've decided on which assets we're investing in, which regions that we're investing in, constructing a portfolio that can be flexible enough to tolerate this variation in the amount of water that we're going to get allocated each year. So generally there's a couple of different types of water entitlement in each region. Some are very expensive, but they're highly reliable. They will get water allocated even in the worst drought years. So they tend to represent the bottom component of the storage system, so the dams themselves, where even in a drought year, they're going to get allocated water. And that tier of water security, they're more expensive to purchase because of that reliability. And then generally the bulk of the water in any region tends to be of lesser reliability and has more variation in how much water you're going to get allocated. So in a wet year, you'll get fully allocated. In a dry year, you might not get anything at all. So our mission as an investment manager is, how do we construct a portfolio that consists of a combination of those assets? So we have some high security entitlements that cost more, but we're going to get water and we'll be able to generate income and yield in driest years. And then for wet years that we get a lot of water, we'll be selling it at a lesser rate, but it also mitigates and produces a lot of income even in a wet year. So there's sort of the combination of things which we set up for. And then in terms of generating that income, there's two ways that we can go about it. Three really. There's, first of all, we can lease out these water entitlements over multiple year periods. So we look to say, what are there irrigators out there who will like to lease the asset from us? So they get the water each year and they pay us a fixed rate. Regardless of how much water gets allocated, we're getting a sort of fixed rental against this asset for a multiple year period. And typically we've tried to lease up 40, 50, 60% of the value of the fund for periods of 3 to 5 years rolling. Some lease terms even go out to 10 years now, where we have particularly permanent crop irrigators who have a need for water every year to support those permanent crops, that they're willing to pay a rental of, say, 5 or 6% of the underlying capital value of that asset to get the water supplied to them every year. And then we also don't lease out other assets, which we then receive the water that we're selling throughout the year to those two irrigators. And that might be that we sell forward. So we don't have a need for the water ourselves. We can then forward sell to these irrigators across different periods. It might be 6 months forward, 12 months forward, 18 months forward, where we've got confidence that we're going to get allocated the water because we've got high security entitlements. We can make a price for that and offer that to counterparties for supply in future years. And then we also have a capacity to carry water over, to effectively warehouse water when it's in surplus and carry it forward to then sell in a future period when it might not be so abundant. And so each of those three things is how we derive income for the fund. And generally, we blend all of those things together. The way that the seasons have run over the last few years, we have had between 2021 and 2024, we had this run of really wet years of abundant water supply where the spot price of water was relatively low. And during that time, a lot of the leases that we'd written basically started to roll off. 3 and 5 year terms that had started to expire, and the irrigators had a choice of renewing those leases or just buying water in the spot market as they needed it. And as it turned out through that period, it was a lot less expensive for them to just buy the spot water rather than committing to another lease period at a higher rate. So we have had a period where it's been quite challenging for us to generate that income because there's been such an abundance of water for a long period of time. It's quite an unusually lengthy period of time where we had this consistent supply. But in the last 18 months, that's definitely changed. And now we've reverted to a situation where the dam levels are closer to sort of 50 to 60% full rather than near 100% full. And summer rainfall has dropped away and the water use has escalated and the demand for the amount of water available has come up. So the spot price of water is now pretty much in line with what lease rates would be otherwise. So it's changed the sort of dynamics a little bit where irrigators now are a bit more concerned about the future risk. If we have another dry year, we're going to see a greater scarcity of water and they're going to have to pay a lot more in the spot market. And so this is a time where they now start to think about, do we enter into a lease for the next 3 to 5 years to mitigate that risk?
And in terms of the water market itself, are the prices relatively transparent, or is the spot price the only sort of transparent price that people can look at? And I guess it's different in every region and things like that. So in terms of, I guess, given your footprint, you obviously have probably a reasonable advantage of seeing where water is trading in different regions. How does that sort of function when you compare it to, say, other commodity markets?
Yeah, so it's very geographically specific. So there are lots of different water markets, if you like, and the water itself is usually constrained within a particular district. So it might be a particular river that there's water available in that river, but that water can't be transported to another river system. So each of these is like its own individual market, and location is important.
Yeah.
There are some regions which have and support, very high value horticulture, table grapes, citrus, almonds and the like, and other regions where no, you can only really grow cotton because you don't have the same ability to have water supply every year. So some regions are just much more variable in their supply and then tend to just grow annual crops. Other regions you can invest and develop these higher value horticultural crops. So each of these markets is something where you have to delve into what is happening locally in that particular regional market. There's a range of different water brokers who facilitate the trade of water. Some of them have online portals. That's relatively easy to see the bid and the offer. And then there are others which tend to be more conducted by private treaty discussions between a buyer and a seller, maybe intermediated by a broker or not. Eventually, all of the transactions get captured because the water itself has to be, transmitted between someone who owns those water in their account to somebody who's needing it. And that involves going through a state government water registry who effectively can debit one account and credit another account with that water and right to take it out of the particular river system. So that information capture happens after the fact, but in terms of looking at the price today, it's typically looking at 2 or 3 broker portals online that gives you a gauge of where are the last transactions, what are the volume of bids, what are the volume of offers. But it is a market which is quite unique in the fact that water doesn't have a substitute and it's very expensive to transport. It's a very dense. And so gravity is really the only way to transport this stuff. And so it's regionally specific. You can, in times of scarcity, like we sort of have at the moment, you can get very skewed situation where the bid and the offer can be a long way apart. You have Most farmers are needing the water themselves. The ownership of these water rights is largely still concentrated in the hands of farmers. They need the water. They don't want to sell any. Everyone wants to buy it, but no one wants to sell it. So you get very wide bid offer spreads and everyone motivated the same way. And then that can switch. You get a rainfall event, the soil's getting supplied water for free falling out of the sky. And people go, I don't need that water for irrigation and I've got surplus. And then you can switch quickly to, okay, we can sell. We don't need this. But then everyone going, well, we don't need it. It just rained. Yeah. And so those things tend to mean that you get a lot of volatility quite quickly and a reinforcement. And so that's where, from our perspective, having the ability to sort of go, can we buy and warehouse this and sell it later, becomes part of our strategy of how we might engage in this water market in each individual region.
Okay, interesting. Yeah, I guess in terms of then looking at the market, again, trying to what similarities there are between other commodity markets. From what you've just described, each little region has its own supply and demand balance sheet to a certain extent because, the water can't move between one to the other as freely as you would think. Yep. And I guess then you have to be maintaining sort of a view on each region or even sub-regions of that to have a good view on price and also where there could be asset appreciation or what strategy you want to deploy in that specific region. Yeah, it's really interesting. I hadn't really thought of it that way before.
Yeah, that's right. I mean, each region, there are some where there's some connectivity. So most of the turnover in water transacting happens in the southern Murray-Darling Basin, and there are rivers there that do connect. So the Goulburn runs into the Murray, the Murrumbidgee runs into the Murray, and the lower Darling runs into the Murray River. So those are described as the southern interconnected system. And often they are regions that you can transact water between and across, but it is subject to some limitations. So there are some physical delivery constraints that come into play. There are times, windows that open up where you can transact across rivers, and that provides some arbitrage opportunities, but they can close pretty quickly because people will jump on that pricing differential and arbitrage it so that the volume flows. And then you reach these physical constraints where you go, okay, we can't actually deliver more water through this particular point between one river system and the other. So yes, there are all of these rules around the deliverability of water and how it can be transmitted between those particular regions. And then when you come into other river regions, they're just confined. And so you're just looking at that particular system itself. And so, yes, it does require us to have a pretty good understanding of what are the different competing crops that are demanding the water, what are the relative economics of those crops, what's the capacity for farmers to pay for water in those particular regions, and that itself can be quite dynamic. To give you an example, say in the Murrumbidgee where we have cotton production these days, before you plant the crop, a cotton farmer would consider, okay, what is the price I can afford to pay for water I've got to irrigate 10 megalitres a hectare across the growing period that starts in mid-October, and I'm going to be harvesting that crop, say, in May and June. How much can I afford to pay based on the cotton price that I can maybe forward sell and based on the inputs of fertiliser and seed and so forth, but also just water. 10 waterings, what can I afford to pay? Now, prior to planting the crop, that grower might say, I can actually afford to pay up to $200 a megalitre to acquire all the water I need for 10 waterings, 10 megalitres a hectare. Once they've planted the crop, they're more committed, they might have forward sold some, and you get through to periods where, say, right now, this last week, we had temperatures that were well into the mid-40s, very high temperatures. The crop is burning up, they're using a lot of water. Their risk then is, if I don't put on another water right now, this crop is going to start shedding bolls. I'm going to lose yield. And the marginal value of that one watering I put on now is vastly greater than $200 a megalitre. It could be the difference between, losing 2 bales a hectare, which is a gross revenue might be, $550 a bale. You go, okay, how much of that am I going to pay away to keep those bolls on the plant and keep my yield profile high? So all of a sudden they go, I have to pay $400 a megalitre. I will, because it's worth 1,100 to me to not have it on there. So that also shifts things around a bit, and is quite another interesting component of the, I guess, inelasticity of price for water. It just doesn't have a substitute, and to understand what people are willing to pay throughout the year before they planted annual crop, once they've planted that crop, what's their sunk costs, what's their opportunity costs of not applying it, and then the permanent crops, of course, as well. Many of them they have to water all the time to keep those trees and vines alive, and what capacity do they have to pay for that water through time, and what is the rate at which they think they can disincentivize someone else so they can buy that water. So, for instance, we see, prior to cotton being planted or prior to rice being planted in that window of sort of spring, in October, November, the permanent crop guys might go, okay, if I bid over $200 and the market rate is at that level, it'll discourage the cotton guy from planting. So that volume will be available for me later in the season. If I can trigger the market to make sure that the annual crop area is lesser, then that should be sufficient for me to get through the season. So all of those things come into play. It's quite fascinating to sort of observe behaviours and incentives and disincentives based on that price and the relative economics of what the different farmers are generating by using that water.
Given that, how much of an impact do you see the sophistication of the farmers that do grow the annual crops, where there is a ability to hedge the crops, the pricing of the crops at least? Do you think that sophistication has increased over time or has become less over time as it's become more corporatized, or are they really sort of focused on what's the best gross margin and at the time the water's available and planting decisions?
Yeah, there's probably a spectrum of players there where certainly there are some, particularly because you can forward sell cotton, but you can't forward sell rice. You can't forward sell almonds. There are opportunities that do open up where, and we've participated and serviced this exact same thing, where we have clients who will, we're watching what cotton forward prices are doing. We might have someone who goes, look, $650, $700 a bale. I'd love to forward sell some up there when the opportunity presents. If I had the water, I know that I could grow that crop and lock in a great margin. And certainly there's been plenty of occasions where, we've seen some farmers lock away that forward price and at the same time buy forward water from us to actually grow that crop. And it's part of what drives our returns will be their ability to forward sell means it improves their ability to forward buy the water from us, which we're facilitating their risk management of that future enterprise and their ability to then sustain their workforce. So it tends to be those corporate end of farmers or larger farmers who will go, look, I want to maintain the reliability of my production enterprise. If I'm able to forward sell, I'll forward buy the water, then I'm locking every element away here. Everything else is something that is more easily managed. But the risk of what's the commodity price going to be, what's the cost of water are two major drivers of the extent of how much they might plant. So we do see that. And then at the other end of the spectrum, we have, there's quite a lot of permanent crop enterprises out there that don't own any water rights at all. They're completely reliant on buying the water they need.
Wow.
And they've made a judgment to say, look, we make that much money out of this particular crop that we know we can outcompete the rice grower and the cotton grower for water. And there are times where we're going to have to pay up to do that, to make sure that we disincentivize them and secure what we need. Their gross margin is such that they have that capacity. And some of them, as it's Cobram Estate Olives is a great example. We're publicly listed company, so I can talk about it, that they have a brand on the shelf in the supermarket. They're fully vertically integrated and they have 40,000 megalitres of water they need each year. They don't own any water rights. They have to buy the water they need every year. But the margin that they might have to pay might represent a very small fraction of what is the cents a litre bottle price at the retail level. So their capacity to perhaps absorb higher cost of water is greater than many other players in the market. And so, we see them having that capacity to go, well, we'll just outbid everyone else when we need to. We'll enjoy low water prices most years, but in some years we might have to pay a lot more just to secure the water that we need in that particular time frame.
Is that also, you see that kind of strategy in some other consumers of commodities, not necessarily water? Is it also just a function of complexity? They just don't want to have the complexity of having forward leases and forward commitments and then having to incorporate that into their financials, and some years they might overpay, and so they have hedging losses, etc. So they just want to keep their life simple. Do you think that's some of it? And it's much easier to explain overpaying for water in a drought, losing money in a hedge.
Yeah, I mean, absolutely. There are so many things that they're managing, many, many other inputs to their enterprise, and all of the processing and the marketing, and just so many decisions that they've got to stay on top of. But water's just one component. And while we see it as a vital component, nothing else is going to be needed if they don't have the water to support the crop. They just look at it as just another input. And sometimes we're going to have to pay more for that than others. And that's just the nature of what they're engaged in. Enjoy the good times when there's a surplus, and hopefully it's not too much water and too many wet years, and that can also impact their yields because it was too wet, too much disease, not enough sunshine. Those things on the other end of the spectrum can impact their returns too. So in most cases it is just another input. And it really then comes down to the individuals and their risk appetite. And even that can be dynamic. If you are, for instance, you plant these trees, whether it's almonds or it's olives or it's citrus, you've got a period of maybe 4 or 5 years where you don't have any positive cash flow. You're waiting for the trees to grow. Your risk around drought in that period is far greater because you've spent all the money. You've put $60,000 or $70,000 a hectare in the ground, and you've got no income. You need to make sure those trees stay alive at that period. So that's when they're probably more inclined to go into some sort of forward purchasing arrangement or a lease to make sure they've got the water through that period. Once the trees are actually producing and they're maturing and they're starting to throw off a lot of cash flow then, and that's when they maybe have more capacity to withstand that risk of, if we have a drought, we're going to have to pay a lot more for water in that year, but we also have a pretty strong cash flow now to be able to withstand that.
And what's at a high level, what's the replacement cycle of those type of crops? Like, is it like 10, 15 years, or is this obviously a bit of variance between citrus and olive oil and the other crops? Yeah,
there is some crops like almonds, for example. They tend to have a productive life about 25 to 30 years. The harvesting is by shaking, and that tends to introduce some disease risk and tends to have an impact over the longer term on tree health. So they tend to be replaced after that 25 to 30 year period. Citrus trees, they can be 50 plus years, and table grape varieties you can change relatively quickly. You might have only 18 months between when you rip them out to then plant them again and get them up to start to production. It comes down to that mix of variety and what is the market price for those varieties and how quickly would it take to change varieties. What's the productivity of new varieties relative to the ones you've got, and how much can you transition out into a new replacement program. All of those things come into their decision-making around how quickly would they cycle out of these different crops. It's interesting, separately to our water fund, we've participated in the development of a lot of these crops as well, and managed investments in farmland asset development. So we have a pretty good understanding of what are the gross margins and how they evolve and change, and what capacity people have to pay for water through the cycle. As you know, I haven't met a farmer yet who doesn't say that every input's too expensive. Yeah. But once you understand the economics of, what is their capacity to pay for water if they have to, it's something which, is vastly greater than
Yeah.
where they've had to pay in the past, depending on enterprise.
Yeah. Just to round it out, I guess one line of, pushback against, you know, investors participating in water has always been, do they manipulate prices? Do you take water away from farmers? And then climate change issues, which are always on investors' mind, let's say. I guess you obviously got across a lot of those challenges because the size of the water fund is now. But in terms of how you think about that and making sure you continue to have not just new Argyle, but the industry as a whole have a social license. I mean, how do you manage that side of the business and that argument? Because there has been some investigations at a high level to the industry a few years ago.
Yeah, I guess first of all, where we came from in this whole equation is trying to invest capital in agriculture to facilitate this development of the sector and particularly for water use, to transition it to its highest and best use so that it's not being wasted on growing a low value crop and instead is directed to higher value cropping and deriving more income and deriving more employment, regional development and processing and exports and so forth. We've always taken the view, and our philosophy is, we're not here to compete against our customers. So we do not buy water to simply hold it off the market and try and profiteer from an emerging drought. We invest in the water rights themselves, and that is an asset that means that we get allocated water every year in perpetuity, and our job is then to sell that water throughout the year or lease it out. So we're providing that service to farmers that then is enabling them to access that resource without having to have their own capital tied up in the ownership of the water right itself. If you're doing an almond development today, you're going to expend somewhere around $70,000 a hectare in capital to get those trees to year 4 when they become productive. The pumps, the pipes, the land clearing, the tree health for those first 4 years. If you had to have a matching amount of water entitlements to supply 15 megalitres a hectare to those almond trees, you're going to need another $90,000 of capital per hectare. So that's the thing that we're assisting with. We're going, okay, well, we'll provide the capital to own these water rights. You can lease them from us. You'll pay 5 or 6% of the rental cost per year to do that, but you don't have to find another $90,000 a hectare. And instead, you can apply your capital, develop another $70,000 a hectare of almonds, and hope to generate 12 and 15% operating returns. So there's the sort of equation that where we try to fit and facilitate the opportunities to develop these markets and assets where, we're assisting the greater development of irrigated agriculture in Australia. So we never lose sight of that. We're there to try and facilitate that. And if we do, once those acres get planted, they're taking water away certainly from what used to be there before. Used to be growing grass for cows and dairy and you're generating $100 a megalitre return. Or maybe it's rice growing and you're generating $200, $250 a megalitre return. If you're growing almonds, you're generating $600, $700, $800 a megalitre return. If you're generating table grapes exporting to Japan, you may be generating several $1,000s a megalitre return. It's a 20-fold improvement on what was there before. But somehow you've got to get the capital to do that because banks historically, the only mechanism for a family farming business to do that traditionally has been bank debt.
Yeah.
And if you're growing an annual crop like rice or cotton or dairy, the bank will lend for that purpose. But if you come along to the bank and say, look, I'm going to plant out some trees, it's going to be 5 years of no cash flow, the bank's going to, sorry, can't help you.
Yeah.
So we're denying that kind of opportunity, that traditionally. So we've come up with more innovative ways to be able to facilitate that with the farmer's own capital. They own these water rights. They're typically a large component of their balance sheet, 40, 50, 60% of their balance sheet. If a part of that can be liberated by selling the water rights, leasing them back, or just buying the water as they need it, they can then invest their own capital through that 4 or 5 year development phase themselves to then become vastly more profitable in the use of water. And the bank will jump all over themselves once they've got those trees established and they're throwing off 20 times the revenue that they were previously.
Yeah, that's interesting. What do you, I guess just generally in Australian agriculture, having been away for a while and come back personally, I think what's like is a bit of a generalisation, but seems to be a trend where pre-farm gate Australian agriculture remains very innovative. All the things that you've just described in terms of going from cotton and rice to other crops. And I think, but even those, generally the cotton farmers or grain farmers nationally, they're a very innovative, productive bunch. But Australian agriculture, traditionally, like post farm gate, the commercial enterprises that operate in and around it, probably less innovative, let's say. Would you agree with that statement? Do you think it's changing? Do you think, Australia is a relatively small country population wise? Is it just a function of our isolation and size? Or, what are your sort of thoughts on that, sort of more from a top level?
I think certainly it reflects what are the cost pressures and productivity is required to stay ahead of the increasing costs, whether that's cost of labour or cost of water, people particularly looking at the efficiencies that they need to generate. So, yeah, I definitely think most of our farmers are really looking at what is the return they can generate per megalitre of water, because if they can't, then they're going to sell out. They're selling their water rights off to somebody else, and there's a market there for people who will buy them and pay them more. The same with their farmland as well. Eventually, someone and their neighbour goes, look, I'll be willing to pay more for the asset than that farmer thinks that they can generate themselves. So we've seen that evolution. We've seen this scaling up, I guess, of the amount of land that gets managed by the better farmers who have higher productivity, and that's shifted. The tide has been rising, really. And everyone's looking for that edge then as to how to stay ahead. We don't have, compared to, say, US or European farmers, just in the US alone, their crop insurance program means that they can have a failure and still get income, whereas we don't have that safety net. So it sharpens the focus, sharpens the mind around managing risk. And I know, talking to other farmland investment managers in the US, for example, they have vastly more farmland there that is owned by institutional investors. And their equation is, look, we'll own it, we'll rent it out to a farmer, and we'll get 5% rental income a year, and we should get an average of about 5% capital growth, 10% return. Not involved in the operations, is simply renting it out. They've come to Australia and tried to apply the same model, 20 years ago, and found, hang on, we actually can't get a 5% rental because there's too much variation in climate and rainfall that no one is going to pay that because it's too great a risk. The US farmer has a farm program, insurance program, that if they have a crop failure, they still get the income to be able to afford the 5% rental on the land, whereas the Australian farmer doesn't. And so that's quite a different model then, where the rental income that somebody institutionally buys the land and wants to rent it out to a farmer, there's a greater risk around whether that rent can be paid, and a smaller pool of farmers who are willing to actually continually rent when that may be a really big expense when you have a drought year and you can't produce any income at all.
Do you think there's a place for maybe not a government-backed, but an insurance program in Australia? I mean, we do pay out drought relief and things like that sporadically. It tends to be to the least efficient farmers. But do you think, that has been the weather derivative market here in Australia is finally getting some legs, which is kind of tangentially related?
Yeah.
But do you think there's a place for it, or do you think it just end up creating inefficiency?
I think the issue we have is Australia's climate is so variable anyway that the risk is too great to underwrite that sort of program. Politically, we don't have there's no votes to be won.
No.
And the regional communities, not just the farmers, but the regional communities just still represent such a small component of our politics that we don't have that political power. US farming, obviously they have less variability of climatic variation than we do, and that means you can probably apply that sort of crop program, insurance program, and it's not unreasonable to have that funded. Whereas here, the costs would be too great. So individually, yes, I think it means that, individually you can make that assessment as to whether you want to pursue the weather derivatives yourself, but there's not going to be any community-backed, taxpayer-funded scheme that's going to underwrite the farming businesses, unfortunately.
I guess sort of one thing I wanted to touch on too, because I think, you've built a fantastic business. It's grown a lot over time, well over $1 billion worth of AUM. But, when people see that, they see the success. And, you ask anyone who's run their own business or been through a successful business, it's generally not linear. Your business, the water business, which used to be part of another asset manager called Blue Sky, got caught up in a lot of controversy around 2017. Memory serves me right. Without, you don't have to go into the nitty gritty, but I guess I think it'd be interesting for people to understand, how that came about. You also got drawn in as being CEO of the group, and then Argyle, as it is now, got spun out. Private equity got involved, and now you're sort of obviously standing on your own 2 feet for quite some time now. But sort of that saga in terms of the lessons you got out of that, and I guess for some of the younger listeners, stress does also build some resilience, I guess, is kind of the point. And that was pretty stressful time, Share whatever you would like. I just think it's a really interesting episode in the growth of the business.
It's certainly, it was an incredibly challenging time. So when we started, we talked earlier about how difficult it was to raise capital. So the business I'm a part of started with 6 shareholders, basically privately building out this business to invest in water rights. And it took a long time. And really for the first 5 years, we were doing that tough and just funding it ourselves, trying to actually grow. And it came to a point where we were approached to roll up into a bigger platform, which was Blue Sky Alternative Investments. So we became a component of a bigger alternate asset investment management business, which was publicly listed. We very much stuck to our disciplines around, okay, we're targeting institutional capital in our business because of the nature of water rights, because of the difficulty in explaining to people. Was like, okay, if I'm going to have a conversation with someone to win capital, I'm hoping that the person I'm talking to is going to write me a $50 million check rather than a $50,000 check. So we targeted that particular, sector of the market and built our disciplines accordingly. And, we had tremendous amount of discipline in what we were doing investment-wise to get through to have institutional clients. The other parts of the Blue Sky platform had typically targeted high net worth individuals and self-managed super funds, private wealth, and a lot of the deals they were doing in private equity and private real estate development and venture capital even were from investors who wanted to invest in individual deals. And so that platform basically built and had some great success in building out, but a lot of the focus was on individual private equity deals. So the investors they were targeting were going, we want to pick and choose what we're going to invest in. So at its peak into 2018, that Blue Sky Alternative Investment Platform had 90 different funds, and most of those were individual assets in each fund.
Yeah. Okay.
Because that's what that audience wanted. They wanted to have a choice to say, what do you want this money for? What's the business case? What are you investing in? Let me have a look at that. Oh, yeah, I like that. Now, if you have a portfolio of 90 things, I can guarantee you there's going to be a dozen or so that are not performing well. And that was indeed the case. There was some things things didn't go to plan, and those, dozen or so became the feature for a short selling attack, which was, okay, here's this darling stock that's raced ahead. It's managing $3 billion worth of assets. It's generating these sorts of earnings. It's still growing quite fast. The stock was priced for further growth. It was the stock was the management firm itself. Okay, we're managing 90 funds. There's fees that are being earned to do that, and performance fees that are being earned out of the successful exits of these things. Largely, that was what was happening. But when it came to, hang on, this is trading at 30 odd times earnings. This just doesn't make sense. let's focus on these dozen funds here that are not performing and criticise that to the point that it actually is going to erode confidence across the whole platform. That if those dozen things are bad, everything must be bad. And that was really the root of the demise, was that once that sort of took hold, and it was a really furious campaign by short sellers and the media, and the articles just kept on generating. It was really hard to combat. And the stock price fell, and that eroded confidence further. And basically, despite the fact that 75 of the 90 funds were doing okay, the focus became all these ones are poor, so everything must be poor. So that's one way to look at it. And I think it generated its own momentum of undermining trust. Sure, in building a business that quickly, there were things that were, could have been tidied up, which is when, I was running a division, and then I got asked by the board to go and fix everything else up because the division we were running had these disciplines, was performing well, had institutional clients. That's what we needed to look like. How can we do that with the rest of the business? That's what we tried to do, but it just became almost an impossible task. And unfortunately, yes, the biggest lesson out of it all was you're managing other people's money, and trust is critical. And once that becomes undermined, however that happened, it's awfully difficult to recover. And so ultimately, the decision was made, look, we just actually have to cut off the head of this thing. The businesses underneath it, some of them are very sound, and we need to rebirth them through a private equity process, which essentially is what happened. So large components of the business have then continued on their own, and with their own specialties and their own teams that have then continued to build out and perform ever since. But it was a hell of a lesson, and a really difficult time to experience all of that and the stresses involved, and the reputations that were tarnished as a result. The only way to sort of combat that is to then continue to try and deliver for investors, which is what we've continued to focus on, is at the end of the day, live through that experience and continue to deliver on what we said we would do, basically managing these investments in irrigated agriculture, water and farmland to the best of our ability. Largely, that's basically what ourselves and a private equity group and half of the venture capital team have continued to do under a new badge.
Yeah. One last sort of area I wanted to touch on in terms of alternative assets and their attractiveness to allocators either within Australia or internationally. How have you found that over the last 15 years as the domestic super industry, continues to asset gather? They have huge portfolios now. Are they becoming more interested in that sector? Are you finding more interest from offshore? How would you sort of describe the landscape in Australia today?
Yeah, I think the issue always, for me, it comes down to the investor's tolerance for liquidity. And there's real differences, when you look at the Australian superannuation system versus, say, the Canadian pension funds. In agriculture, we've seen a tremendous amount of investment in Australian ag from Canadian pension funds, but they are defined benefit schemes that have an investment horizon which might be 20, 30 years long. The Australian supers are so obsessed, really, with liquidity because it's a defined contribution scheme and super is portable. If you are in a super fund and you want to shift to another super fund, you can lodge your paperwork and they have to move your funds in 3 days. T+3, right?
Yeah.
So how can you actually then justify an investment to go, okay, we're going to invest in farmland and you've got to be able to do a 10-year long investment in these almond trees because it's going to take you 5 years before they get to maturity. It just doesn't marry well with someone who's really looking at, we've got to, be obsessed around liquidity. Can we get out of this thing within the next 12 months? Because I've got to satisfy, APRA around my liquidity if someone wants to get out of my fund and go to another one. So they're the things that, really to my mind, are important to consider is what's your investment? What is the investor's appetite for that alternative investment, which is going to have illiquidity? And what's the return you can generate that justifies that illiquidity? Are you getting a premium to actually have something that's locked away for 4 or 5 years before you can actually redeem? So they're the sorts of trade-offs, and they're the things that become really important. Hedge funds obviously have liquidity as an alternative investment. Property funds, REITs, the way that they're structured, maybe greater liquidity. Agriculture, it's not liquid and it's not something that's easily sold. And you have the climate cycles that can impact in terms of, and commodity cycles that can impact on when you're going to generate the best value as an exit from those particular farmland investments. So you have to have greater tolerance for illiquidity. And then you have to, as a manager, be able to have an investment case that justifies that illiquidity. Can you return 15 plus type annualized returns? It won't be a straight line. It will be lumpy. And you're going to have periods where you just got to have the tolerance to go, okay, this is a 10-year long investment and I have to be patient. I'm going to hit some bumps. There's going to be some droughts, so there's going to be some floods along the way. But over that longer term, will it perform? Been instrumental along with our peers in creating a thing called the Australian Farmland Index, which is actually tracking a portfolio of managed farmland investments. So, and it's now been going over 10 years. And it does show a return profile which is quite compelling, that you can get 10, 12% annualized returns over that investment horizon with volatility that's quite low, only 5 or 6% vol, but you need to be looking at it over that whole period, because there are times where, commodity price or seasonality means that your annual return might be a negative, but over the longer term, the asset performs well relative to equities, relative to commercial real estate, industrial real estate, agricultural investments managed well, sit well alongside that.
Yeah, it's interesting. Sort of from a cycle perspective, you look at the operating returns of most agricultural businesses, right? They're likely to be 5%. I mean, most of them are sort of low single digits. And so all the gain is coming through capital gain. And I incorrectly would have assumed that sort of higher interest rates would have slowed that down. But certainly in Australia, land values don't seem to be going. They might have plateaued a little bit, but they're certainly not going backwards. And part of the other side of the inflation argument is you also want to hold on to things that they can't print more of, and you can't print more of land. That's probably going to, the drawdown should be relatively subdued unless interest rates went a lot higher and it sort of changed the cap structure problem. But
and that's what we tend to see is that, yes, farmland and water as well, we tend to have periods where there is an appreciation that is reflecting some productivity change, whether that's better utilisation of machinery, new varieties that are being grown, some efficiency that encourages the farmers to expand and buy out neighbours and so forth. You get some appreciation. Then you might have a period of consolidation where we don't see the capital appreciation for a while, or we might be going through some droughts or floods or pest or disease impacts but typically the farmer themselves is resilient enough to go, we're holding in here. We don't want to sell. We know these things are worth what we paid for them or more. We're just going to be patient and get through this period and wait for the next uplift before we might be looking to exit that particular land parcel. And yes, it is certainly inflation linked. You're producing food, and it has been a long-term store of value. And you don't see it go to zero. It holds its value. It's worth something and has a tangible value. And somebody else, particularly if you can transition it, which is what we're involved with, is how do you move that asset from a particular enterprise to a new one? And that's where a lot of value can be unlocked. So when you look at the history of sort of Australian agricultural investment or the performance of farmland, typically the ways to generate strong returns is you have to either buy very well, buy when it's distressed, buy when everyone else is going, there's no way I want to get involved in that industry right now. That's the time to enter. And for an investment manager, that's impossible to try and generate, raise the capital at that period, because everyone's looking at it going, you're bloody crazy. But that typically is one way to do well. And the second way is changing the use of the asset, changing the productivity of that particular soil and water combination to grow a higher value crop. And that has tended to be what we've focused on. If we can buy that wheat farm out competing the other wheat farmers, but we're going to turn it into an almond orchard, that is a vastly different set of economics, and that's where value can be generated.
Yeah, interesting. It's an ever evolving landscape. The last 25 years, especially in Australia, seen trees into agricultural land, grains replace grazing properties, and then more recently, what you're talking about, citrus and almonds and table grapes replacing a lot of what had been. I guess the cycle will continue. I guess as things develop.
And, in some of those industries that we have had in Australia a long time, like citrus or table grapes or almonds, they were constrained just to a domestic market. So we had a very small population that required that, and it was really easy to then overproduce and then have the price decline. But it has been a result of these free trade agreements, rise of per capita wealth across Asia, the demand for these products that we can produce has lifted the capacity for us to produce those crops. And it's quite fascinating too when you drill into those individual enterprises. When it was just a domestic market, some of them were not terribly productive, and they were just following a pattern that had been in place for decades. But some new technologies and new thinking and expansion, and you get some pretty significant productivity gains. Citrus, for example, when we got involved, the average yield of citrus in Australia was about 40 tonnes a hectare. But the best growers were getting 80 tonnes a hectare. But when it was a domestic market, none of those guys were going to tell any of their neighbours why they were getting 80 tonnes a hectare, because it would just result in a decline in the domestic price. Now we have an export market, large volumes. That information is now being disseminated more freely, so that everyone can aspire to be an 80 tonne a hectare grower and not have an impact on the price. So the productivity gains are extraordinary, where you're taking these 40 tonne a hectare places to 80 tonne a hectare through better agronomic practices, better application of fertiliser and ag chem and water, and better varieties. You get significant uplift in those assets that previously were managed just for a domestic market, and that's been fascinating.
Yeah, actually, it was something that was raised on another podcast, and I was talking about Australia's economy in general and how the ag sector is the most productive and continues to grow. And one of the observations from a non-agricultural person, an academic, probably sitting in Canberra, but he was saying, the propensity of farmers to share information, whether it be grain growers or citrus growers or, sheep farmers or cattle farmers. And I guess it's because we are export orientated, so it's not a zero-sum game. Everybody gains if we produce, significantly more, as an example you just alluded to. And I think the younger generation, I would say, sort of, by that I don't, mean say people 50-ish and younger, who are more on social media and also trying to grow their own businesses through information sharing as well. It's been really interesting, actually. You see a lot of it on ag Twitter, both here in Australia and in America. Like, I've got this soil type. Do you recommend this fertilizer or this chemical or what have you? And I guess everyone's trying to grow the size of the pie, which is good. That's capitalism at its best, right?
Yeah. You're right there. It's certainly some industries, when you look back at the history of the evolution of all of that, cotton industry that you and I were a part of, has really been in the vanguard there as far as information sharing and the technologies, the investment in the plant breeding. Their comparative analysis of financial performance has been going for 30 odd years. And that's been sort of a key component of them being able to share information and lift the whole of the industry. So, other industries have certainly adapted that same benchmarking system, and that's improved their performance as well. But it is interesting to sort of look back at what did that industry have that others didn't, that created that sort of circumstance? It didn't have, in New South Wales at least, it didn't have any government involvement in their marketing system. They had to invest themselves in their own processing capacity and their marketing of the crop in international markets. There wasn't any regulatory, statutory marketing boards that were created. So the industry and the people in it, originally coming from the USA, would shun government involvement in their industry. It's like, we need to do this ourselves. We don't want to be reliant on anything from government. We'll fund the development of our own processing facilities. We'll fund the development of our own markets. We'll fund the development of our own varieties here. And in a lot of ways, that's has been a secret to their success, I think, over time. Whereas other industries in the past in Australian agriculture, going back through history, they put in place statutory boards in the 1920s and 1930s to, at the time, combat their inability to get information about the market, because the farmers were at a disadvantage when you had traders who knew what was going on around the world and being able to understand that, taking advantage of a bunch of farmers who had no ability in Australia to know what was going on. So some of the things in the way that they've evolved, and the statutory boards, the common denominator type thinking that might have occurred in the past, was a constraint, and I think that's largely been overcome. And the productivity as a sector that we can see in agriculture, yes, we've been leading the Australian economy now for the last 20 years or so as an industry sector that has led productivity growth in Australia.
Yeah, I mean, you compare and contrast the cotton industry to the other natural fiber, wool, right? I mean, wool's still a debacle 40 odd years later after the deregulation, etc. So, yeah, I think that's a good counterfactual. The other thing I think as well is that, Australia agriculture by nature is super volatile with aspects you can't control, and that productivity has continued to improve despite that volatility that you can't control, or you can't control the weather. It's even more impressive when you take that as a backdrop. Look, Kim, I think I'll leave it there. I've taken up enough of your time. This has been an excellent conversation. I really appreciate it.
Oh, thanks very much, Henry. I hope it's been interesting enough for all the listeners. Thanks for the opportunity to have a chat with you.
I hope you enjoyed this episode of the GSX Podcast. You can find out more about GSX at greatsouthernx.com and follow us on X at GSX Commodities. You can also follow me, Henry Walsh, at H2Walsh. Until next time.